So welcome back everyone. In this new lecture we are going to continue with question number 34 onwards. This is going to be an interesting question. Let's have a look. Trupti Company Limited, promoted by a multinational group, International Incorporation, is listed on stock exchange holding 84%, that is 63 lakhs shares. I will give you an advice in the mergers and acquisition chapter. Like by whenever you start the question, reading the question, start your calculation at the same time. It will help you to develop a mindset to solve the questions of mergers and acquisition. Don't just read the entire question and then again start with the first line. You can clearly see this Trupti Company Limited is a company whose promoters are International Incorporation. Okay, just a second. And you can see that they are holding around 84% of the total stocks in the company, and that 84% is around 63 lakh shares. So can you calculate the 100% shares in the company? Yes sir, that's very easy. Just a second. See, when you will divide 63 lakhs with 84%, you will get 100% of the share. That comes to 75 lakh. Right now, the company has 75 lakh shares in its capital. Profit after tax is 4.80 crore. Now understand the very first difference. This is in lakhs, this is in crores. Can I write down as 480 lakhs? Instead of 4.80 crore. Now I have 75 lakh shares and 480 lakhs of the profit after tax. Can I calculate the EPS? 480 divided by 75 lakh. The EPS will be 6.4 rupees per share. Free float market capitalization is 19.20 crore. Try to understand, 84% is the promoters holding, that means 16% is the free float holding. So if you will divide the entire free float market capitalization by the percentage of holding, you will get the total market value. First of all, I am going to write down it in lakhs. So this is going to be 1920 lakhs divided by 16%. So the total market capital is 12,000 crore, or sorry, lakhs. Okay, so with the help of this we can also calculate the market price, which is 12,000 lakhs divided by the total number of shares, which comes to 160 rupees per share. So existing market price, or we can say current market price, is 160 rupees per share. See, lots of data. Now, as per the SEBI guidelines, promoters have to restrict their holding to 75% to avoid delisting from the stock exchange. Now, the SEBI says that you cannot hold more than 75% of the shares of the company. Now, there are two ways to bring your holding from 84% to 75%. You can sell off the rest of the percentage, like for how much percentage? 9. It's coming to 9%. You can sell 9% of your shares to the public, or instead you can increase the total holding in the company, total shares of the company, and distribute all those extra shares to the existing shareholders as a bonus shares. You don't take the bonus, you distribute the bonus to the public. That will increase the total number of share from 75 to something else, and your holding will still be 63 lakh rupees. 63 lakh shares, sorry. So there are two ways to bring your holding down. You can decrease the holding from 84 to 75, like you can sell off some shares out of 63 lakhs, or you can increase the total shares. Either you sell your shares or increase the total shares so that your holding should be 75%. Now, the board of director has decided not to delist the share. If you don't want the shares to get delisted from the stock exchange, you will have to comply with the SEBI guidelines. But to comply with the SEBI guidelines by issuing bonus shares to the minority shareholders while maintaining the same PE ratio. Understand, who is the minority shareholder? The 16%. Okay, and they are holding right now 12 lakh shares. 63 minus 75, 12 lakh shares is being held by the 16% of the free float, or we can say minority shareholder. We are going to give them bonus. How much or how many shares has to be given or issued as a bonus to these 12 lakh shares so that our holding becomes 75%? So one thing is very clear, that we are not selling a single share from our pocket. 63 lakh shares right now, 63 lakh shares right now is 84% of the total company. We have to make it 63 lakh as 75% of the total company. So if 63 lakh has to be 75%, then the total number of share has to be 84 lakhs. Understand? Right now we have only 75 lakhs shares. That means you have to issue 9 lakh shares, and that will be issued as a bonus to 12 lakh shareholders of minority. Am I right? There are two groups right now. If you take 75 lakh, there are two groups. 63 lakhs, that is promoters holding, 12 lakh, that is free float holding, right? You have to make this 63 lakhs as 75%, right? So you have to distribute 9 lakh shares to the free float holding. So what will happen? After the bonus issue, the total number of share will look like 63 lakhs held by the promoters and 21 lakhs held by the free float. The total will be 84 lakh shares, and 63 will be 75% of the 84 lakh. This is how you are going to comply with the SEBI guidelines. So 9 lakh shares will be issued to these shareholders, 12 lakh. Okay. The first question is, what is the PE ratio? It's market price divided by EPS. So market price is 160, that we have just calculated. EPS is 6.4. We have this PE ratio. That's 25. What is the bonus ratio? We are giving 9 lakh shares to 12 lakh shareholders. The bonus ratio is 3:4. Am I right? These 9 lakh shares are being issued to the 12 lakh shares. That is minority. So the bonus ratio is 3:4. For every minority shareholder who is holding 4 shares, he is going to get 3 shares as a bonus. Cool. Market price of share before and after the issue of bonus share. Before, it is 160. After the issue, understand now, when you issue bonus shares, the entry will be reserves and surplus debit to share capital. So practically speaking, no additional capital is coming into the company or going out of the company. It's just the reserves and surplus got debited and share capital got credited. So it doesn't impact the overall value of the company, which is 12,000 lakh. But yes, the number of share got increased. So now the market price will be total market value of the company divided by the new number of shares. Earlier we divided 12 lakh with 75. Now we are going to divide 12,000 lakhs with 84. So the market price will come down to 142.86, and it's quite obvious. Earlier this 12,000 lakh of the market value was shared by 75 lakh shareholders, right? Now it is shared by 84 lakh shares. So obviously the market price will come down. Free float market capitalization of the company after the bonus issue. How many shares are now being held by the free float under the free float category or the minority? It's 12 lakh earlier plus 9, that is 21 lakh shares are now being held by the minority, that is free float. So when you will multiply the after bonus issue market price with the after bonus issue number of share, 142.86 into 21, that gives you 3,000. Or the other way of calculating is 12 lakh into 25%, that's 3,000. Because 12,000 lakh is the total market value after the bonus issue as well, and promoters are holding only 75%. Free float market capitalization covers 25% of the total market value. So there are multiple ways of calculating the same answer. Okay, so I'm just summarizing now. This is P ratio, this is bonus ratio, this is before and after bonus issue market price, and the market value of the free float market capitalization after the bonus issue. All the four answers are ready. So without looking at the answer, we have calculated. So this is how you have to do it in your case. Please understand that solving the question without looking at the answer is very important, and you can see every figure is now connected with with each other, so we can do the calculation. You just need to try it before looking at the answer. So that's it. 75 lakhs, 100%, 25 is the PE ratio, 3:4 is the bonus ratio, and after bonus issue the market prices, and this is 3,000 lakh, or you can say 29.9775. It's because of the rounding off of the market price, otherwise it will be same. Okay sir. Question number 35 is your homework. It again asks for the bonus ratio, market price after issue of bonus share, and free float market capitalization. Question number 36. Yeah, this is interesting. Some of the concepts from CA Inter ratio analysis, financial management ratio analysis will be used in this question. Have a look. See, quite good question. This is the question asked in mock test paper of May 2020 for around 12 marks. X Limited is studying the possible acquisition of Y Limited by way of merger. So X Limited will be acquirer here, Y Limited will be target. Okay, the following data available in respect of both the companies. Have a look. Market capitalization is given to you, gross profit ratio is given to you, inventory turnover ratio is given. Now try to recall your concept of inventory turnover ratio. Inventory turnover ratio, that is ITR, is equal to cost of goods sold. Inventory turnover is always calculated on the cost of goods sold, not on the total turnover. Cost of goods sold divided by the average stock. But in our question, only closing stock is given, so we are going to take that much only. So this is going to be the formula. With the help of this, we have the inventory turnover ratio. Here we will take the closing stock from here. We can calculate the cost of goods sold. We can calculate the cost of goods sold for both the companies. So inventory turnover ratio multiplied by closing stock. Can you just try to understand this? This will be multiplied. So can I say 5 times that 5 will be multiplied by the 15 lakh. So cost of goods sold here will be 15 multiplied by 5 lakh, that is 75 lakh. Am I right? The closing stock multiplied by 5. Also for Y Limited, 5 lakh of the closing stock multiplied by 4, that's 20 lakhs. So this is the cost of goods sold. Now one more thing, gross profit ratio is 20%. Can I say that COGS ratio is 80%? Exactly. See, this is the trading account, this is opening stock, this is closing stock, this is sales, and this is purchases, and this is then gross profit. This is the gross profit. Another way of presenting this trading account is very simple. Cost of goods sold, this is sales, and this is gross profit. So if the gross profit is 20% of the sales, can I say 80% will be the cost of goods sold? Exactly. So 80% is the cost of goods sold, and this is the amount of cost of goods sold. Can we calculate the sales out of it? 75 lakh divided by 80% and 20 lakh divided by 80%. We can calculate the sales. So sales figure will be, or should I take it somewhere else? let's write down the cost of goods sold for both the companies 75 lakh and 20 lakh. Cost of goods sold ratio is 80%, the balance, and 80%. With the help of this, we will get the figures for sales. That's 93 lakh 75,000 and 25 lakh. 25 lakh. Good. Acha, apart from that, this is your next item. See, debtor turnover ratio 12% debenture, we can calculate the interest amount of on this debenture, which is 1,20,000, and interest on this debenture as well, which will be 1,44,000. Now this is the number of equity share. We can calculate the market capitalization divided by number of equity share as market price. So 75 lakh divided by 1 lakh. Market price will be 75 in this case, and 90 lakh divided by 60,000. So market price will be 150 in this case. Do you agree? Now the operating expenses. You can see operating expenses are 86%. And operating expenses means it includes the cost of goods and other operating expenses before deducting interest or financial expenses. This operating expenses includes everything related to operations, which also includes cost of goods sold. So if I deduct operating expenses here, that would mean I am deducting the 80% of the cost of goods sold, and rest 6% will be the other operating expenses, which is not directly related to the goods sold. Okay, so let's have a look. 86% of the total sales, we are going to apply it on the sales. 86%, 93 lakh 75,000 into 86% is 80 lakh 62,500, and 25 lakh into 78% is 19 lakh 50,000. So what will be the answer of this? This is going to be EBIT. Earning before interest and tax, you can call it as operational profit as well, or operating profit. If you are deducting operating expenses, the balance will be operating profit. 93 lakh 75,000. Sorry. Into 14%, that's 13 lakh 12,500, and 25 lakh into 22%, that's 5 lakh 50,000. Now you are going to deduct the interest, 1,20,000, 1,44,000. You will get the earning before tax, 1192,500. 406 lakh. Okay, so we have the corporate tax rate also. We can deduct the tax of 30%. I am not writing the amount, and we can calculate the earning after tax. Anything else? I don't think so. Debtor turnover ratio will be used, or debtors will be used. Now, earning after tax when divided by the number of shares. We have the number of shares, how much? 1 lakh here and 60,000 here. We will be able to calculate the EPS. We have the market price. We can calculate the PE ratio as well. So let's do that. 192,500 less 30% comes to 834,750 into 70% comes to 284,200. So EPS 834,750, that is 8.3475. Am I right? And 2,84,200, 284,200 divided by 60,000, that's 4.7367, if I am right. Okay, then the market price is 75 here, P market price is 150 here. P ratio comes to 8.9847, comes to 31.6676. Now what is the question asking us? Swap ratio based on EPS and market price, or respectively as a weightage of 40% and 60%. You remember the weightage? Okay, first of all, let's cross check the answer by the institute and the one that we have calculated. P ratio has to be 8.9847 and 31.6676. 8.9847. See, so it is rounded off to 8.99 and this is 31.65. 6665. Earning after tax 834,750, 284,200. 834,750. You can see 834. I will just highlight that. Profit after tax. This is the profit after tax. Okay, so we have the PE ratio ready. Now we can calculate we can take the EPS and the market price. This is the EPS and the market price to calculate the exchange ratio. What will be the basis of exchange ratio? EPS and market price both are positive factors. The formula will be target divided by acquirer. Target divided by acquirer. So let's have a look. Let's first calculate the EPS exchange ratio, which will be 4.7367 divided by 8.3475. It comes to 0.56 or 57:1. And if we take the market price, it will be 150 divided by 75. So that's 2:1, right? These are the exchange ratios. Now these exchange ratios will be multiplied with the weight of 40 and 60%. So 0.57 into 0.40 and 2 into 0.60, that comes to 1.428:1. This is the swap ratio, 1.428. Let me just check once again. See, 1.427. Rounded out difference, 1.427. That means for every share of the target company, you are going to issue 1.427. They have in total 60,000 shares. So how many shares you are going to issue? 85,620. You already have 1 lakh shares. So the total will be 1,85,620. Am I right? 1,85,620 will be the total number of share. You can clearly add these two profit. 834,750 plus 284,200, and that will be 11,89,000. 11 lakh 1. Just a second. I will write it here. 11,18,950 is the total profit after tax after merger, divided by the total number of share after merger, which is 185,620. This will give you the post-merger EPS 6.028, right? And the P ratio. This is the post-merger EPS. When you will multiply with the P ratio before merger of X Limited, which is 8.99, we will get the post-merger market price, which comes to somewhere 54.19. So we have the answers ready for the next two parts as well. Post-merger EPS, post-merger market price. Very easy, sir. Take the post-merger earning after taxes, post-merger number of share, EPS, P ratio, market price. See, 6.03 or 28 and 54.21. Now the question is asking you to calculate gain or loss to the shareholders. It's very simple, sir. Take the pre-merger EPS and take the post-merger EPS. Pre-merger EPS of both the companies are like 8.34 and 4.74, and the post-merger is 6.03 for target, and for Y Limited, we are going to take equivalent EPS. So one share in Y Limited is worth 1.427, right? So we have to take 1.427 shares EPS to compare with 4.74. So that's around 8.60. So you can clearly see that the this company acquirer is losing out by giving more shares. 8.34 minus 6.03, so they are losing around 2.31. There is a loss of 2.31 to the shareholders of acquirer, and there is a gain of 3.86 to the shareholders of target. That's it, the story is over. Everything was smooth. The only thing to learn in this question was about the turnover ratios, because from here you are going to start all your calculation. Cost of goods sold, sales, expenses, EBIT, interest, EBT, tax, EAT, EPS, PE ratio, market price. If you will understand one simple thing now, every question will be like most of the questions in the mergers will be smooth. And that one simple thing is like this. The operating structure. What is the operating structure? See. This is how it starts. Sales minus operating expenses, you will get operating profit, which is also called as EBIT. Then you have to deduct interest, which gives you EBT. Then you have to deduct tax, which gives you EAT. Then you have to divide it by number of share, which gives you EPS, multiplied by the PE ratio, which gives you market price, multiplied by the number of share. See, EAT divided by number of share, EPS, multiplied by PE ratio, market price divided by number of share will give you market value. This is also divided into promoters holding and free float holding. So there are many ways to calculate. So once you understand this process now, operating structure, you can just shuffle anything and you can calculate the required amount. Okay, so this was the question. Let's have a look on the next one. Question number 37. See, the following information is relating to Fortune India Limited. It has two divisions, pharma and fast moving consumer goods. It has two divisions, pharma and FMCG, fast moving consumer goods. A company which has two divisions. Paid up share capital of Fortune India Limited is consisting of 3000 lakhs equity shares of rupees 1 each. Okay. Fortune India Limited decided to demerge. This is the first question that we are solving for a demerger. Pharma division as Fortune Pharma Limited with effect from 1/4/2009. Details of Fortune India Limited as on 31st March 2009 and of a Fortune Pharma Limited as on 1st April 2009 are given below. Now please try to understand. Fortune India Limited's detail is on 31st March 2009, and this is the trick in the question. And this is on 1/4/2009. So can I say that Fortune Pharma Limited, there are two companies, or let me take it this way. There is one company right now, Fortune India Limited. It has two divisions, Pharma and FMCG. Now they have decided to create a separate company of pharma. Okay? So what will happen after demerger? Fortune India Limited will handle FMCG business and Fortune Pharma Limited will handle the pharma business. Okay. The details in the question of Fortune India Limited is given for 31st March 2009. That means before demerger. And for the Fortune Pharma Limited is given for 1/4/2009. That is after demerger. So the details given for Fortune India Limited in the question includes both pharma and FMCG values because it is of 31st March. But this data includes only pharma. What does that mean? It means that if you will deduct the pharma values out of this, you will get the FMCG values. Simple. You have to deduct the pharma values out of the merged entity. Okay. So we can calculate the Fortune India Limited as of 2009. Understand, this is also Fortune India Limited and this is also Fortune India Limited, but this Fortune India Limited includes FMCG and pharma, but this will include only FMCG. And how to calculate? Deduct the pharma values out of Fortune India Limited. Deduct the pharma values out of Fortune India Limited. That's it. So you don't have to deduct individual figures because there will be some issues at that time. See, secured loans, if you deduct 400 out of 3000, we will assume that all these Fortune Pharma values are included in the Fortune India. So if we will deduct the secured loan 400 minus 3000, so we will get the FMCG secured loan, which will be 2600. But there will be a problem in case of unsecured loan. We cannot deduct 2400 out of 800. Okay, so this is a practical issue in this question. Now what we are going to do for this is we are going to deal in the total, like fixed asset, investment, current assets. See, the total of the current liabilities and provision. This is the total. Let's do the total. 400 plus 2400 plus 1300. So this is around 4100, and 3000 plus 800 plus 21 200, that's 25,000. So you can just deal directly in total, that's 20,900. After demerger, this is the balance sheet, 4,100 and 20,900. Same you can do with the asset side. Right now it was on only the liability part, so just take the total of these two. That comes to 25,100 assets of pharma. That's 70,000. That comes to 44,900. So this is Fortune Pharma and this is Fortune India after demerger. Okay, this is the net assets and net liabilities of both the companies. Now, Board of Director of the company have decided to issue new equity shares of Fortune Pharma Limited of rupees 1 each without any consideration to the shareholders of Fortune India Limited. See, try to understand the procedure. This is the shareholder of Fortune India Limited, right? And how many shareholders are these? Like 3000. I will just show you. Where is that written? See, Fortune India Limited is consisting of 3000 lakh equity shares, right? So we have total number of shares 3000 lakh. Now if we are separating our own company in a new company, so it means that we will be issued the shares of Fortune Pharma Limited. Fortune Pharma Limited shares will also be issued to these shareholder only, because these shareholders are the only owners right now as well. Before demerger, they are the only owners. So now after demerger, they will be holding the shares in two companies, Fortune India Limited, which is 3000, and Fortune Pharma Limited as well. Okay, free of cost the shares will be given to them because it's their own company. For the following purpose, following points are to be considered. Transfer of liabilities and assets at book value, whatever the book value. Transfer the assets and liabilities at book value. Earning estimated profit for the year 2009-10 is 11,400 lakhs for Fortune India and 1470 lakh for Fortune Pharma. We need to start writing now. So this is Fortune India Limited, this is Fortune Pharma Limited after demerger. So first thing is profit after tax, 11,400. 11,400 400 and 1470. Okay. Estimated market price of Fortune Pharma is to be 24.50. So market price of Fortune Pharma 24.50. What else? Average PE ratio of FMCG sector is 42. So can I write these figures here and the PE ratio here and the EPS here and the number of shares here. So profit after tax divided by number of shares is equal to EPS into PE ratio is equal to market price. So I have framed a proper structure. Now I will just try putting the figures in this table. Average PE ratio of FMCG sector is 42. So PE ratio of FMCG. FMCG is now handled by Fortune India Limited only 42 and that of the pharma sector is 25. Okay. Which is to be expected for both the companies. Now we have written all the values. The ratio in which shares of Fortune Pharma are to be issued to the shareholders of Fortune India Limited. Right now Fortune India Limited is handling 3000 lakhs shares, right? The question is how many shares will be issued of Fortune Pharma to the shareholders of Fortune India, because the owners of both the companies will be same. It's just a demerger. The owners are not changing. We are not selling the company to someone else. It's just a one big company separated into two different companies. The owner will still remain same. So the question is how many shares of Fortune Pharma Limited will be issued to Fortune India Limited shareholder. So that X has to be calculated. That's very easy, not a problem. This is the EPS, this is the PE ratio and this is the market price. Now try to understand. One by one we are calculating. Can we calculate the EPS? Profit after tax divided by number of share. 11,400 divided by 3,000, the EPS comes to 3.8. When multiplied with the 42, the market price comes to 159.60. Cool. Now let's come to the Fortune Pharma Limited detail. Market price divided by PE ratio will give you EPS. So 24.50 divided by 25. The EPS will be 0.98. Now, can we calculate the number of shares? Profit after tax and the EPS is given to you. Profit after tax and the EPS is given to you. If you will divide it, you will get the number of share which comes to 1500 lakhs. So we are going to issue 1500 lakh shares of Fortune Pharma Limited to the shareholders of Fortune India Limited, which is 3000 lakh. The ratio is 1:2. You can clearly see the ratio is 1:2. So this is our first answer. 1500 is to 3000, which is 1:2 will be the ratio. See. 1470 is the estimated profit, market price 24.5, estimated P ratio. With the help of these two, we will get the EPS. EPS, and then the number of shares will be like profit after tax divided by EPS, which is 1470 divided by 0.98, which is 1500 lakhs. So 1:2 is the ratio. Now, this is also calculated. 159.6 expected market price of Fortune India Limited. Profit divided by number of share is equal to EPS multiplied by PE ratio is equal to market price. That's exactly what we did. Third part. Now focus on the third part. Book value per share of both the companies after demerger. So in order to calculate book value, we need net worth or shareholders fund after demerger. That's written here. Shareholders fund. Try to understand. 70,000 is the total merged before demerger value, and it can be divided into two parts: 25,100 and 44,900. 25,100 and 44,900, right? So can I write it like this? 25,100 and 44,900 is equal to 70,000. This is the asset side. Similar is the liability side. 25,000 is the total, which can be divided into two parts: 4,100 and 20,900. And now you can calculate the net worth, assets minus liabilities. This is the net worth divided by the number of shares. Fortune Pharma has 1500 lakh shares that we have just calculated, and Fortune India has 3000. Just this is going to be the book value. 21,000 divided by 1500 is 14, and this is 8. Are you happy with this answer? Book value. Book value per share is nothing but net worth divided by the number of share. We have the number of share of both the companies, 3000 lakh and 1500 lakhs. Net worth is the assets minus liabilities. We have the assets total and liabilities total. Don't try to take the total of individual figure, because that won't match. See, deferred tax and miscellaneous expenses, how you will take out 60 out of 200, and in the previous figure it was about the loan. So that will be difficult, so you can take the direct figure. Institute has also taken the total of the assets and then deducted it, and then outside liabilities, and this is the book value. Okay, sir. I hope you are happy with the answer. Let's move on to the next question. Question number 38, 39, 40. These three questions are very interesting questions. These are like big question, you can say. And we are going to learn one of the negative factors to calculate the swap ratio in this. We are going to do only one question, which biggest of the three, and then rest of the two questions will be homework for you. Let's have a look on question number 38. So let's have a look on this question. Bank R was established in 2005 and doing banking in India. So this is related to a banking industry. The bank is facing do or die situation because this bank called as Bank R is in a very bad condition. There are problems of gross. Just a second. There are problems of gross NPA, that is non-performing assets. What do you mean by non-performing assets? The loans which is given by bank is called as advances, or the loans which is the asset of the bank, and now those assets are becoming non-performing. That means the people to whom the loan was given are unable to pay back the loan. So we are on the verge of losing that amount. Lots of people are like, lots of parties and the companies are there who are who does not make the payment or repayment of the loan. Let's say for example, there was a case of Vijay Mallya, Nirav Modi, and there was another case, like there are another cases where farmers are not able to make the repayment of the loan. So whatever the loans given by the bank to the outside parties, and when the outside parties are not, when those parties or the borrowers are not able to make the payment of those loans, it becomes non-performing assets. So practically that's totally a loss to the company. So that's gross NPA at 40%, and the capital adequacy ratio, or we can say CRAR, or capital risk weight asset ratio, at 4%. Now try to understand. Gross NPA is a negative factor. Non-performing asset is a negative factor. It is lower the better. Okay. But CAR, that is the capital adequacy ratio, it itself means we have a sufficient capital, adequate capital to cover the risky assets. This is higher the better. And you can see that for Bank R it is exactly opposite. We have a higher percentage of NPA and a lower percentage of CAR, which is wrong. The net worth of the bank is not good. Shares are not traded regularly. Last week it was traded at 8% per 8 rupees per share. See, so there are three things that is given right now. Let me just write down. For Bank R, and this is another bank, Bank P, NPA, CAR, and market price. 40%, 4%, and 8 rupees per share. Okay, what else? RBI audit suggested that the bank has either to liquidate or to merge with another bank. Either you shut down your business or get merged with the another bank, and now bank P is professionally managed bank with a low gross NPA of 5% and net NPA of 0%. Now what does that mean? See, we have the gross NPA here of 40%, right? And this is the gross NPA of bank P is 5%. That means only 5% of the total assets has become non-performing assets for bank P. So if your gross NPA is 5%, okay, and you make a provision for that also, provision for losses like bad debts. So if you make a provision for of 5%, your net NPA will be 0%. It means that although this bank has 5% of the gross loans in the NPA, but it has made a provision, it has kept a separate capital of that much amount as a provision for this NPA. That means the net NPA is 0%. So there is no need to worry. Okay. So what is the gross NPA of this company? Gross NPA is 5%. Now, capital adequacy ratio at 16% and the market share price is 128. 16%, 128. See, NPA should have been lower. It is lower in case of bank P. CAR should be higher. It's a positive factor. It is 16% in bank P. CAR means that how much separate capital you have to cover up the risky assets. So it is higher the better. You should have a higher number or more capital for covering the risk. Now you can see that this capital adequacy ratio is very less in bank R. Okay, sir. Then the board of director of bank P has submitted a proposal to RBI to take over bank R. Now P wants to take over bank R. Bank P says that we will take this bank, acquire this bank, and the details are given to you. Balance sheet details of both the banks are like bank R, the target, bank P, the acquirer. Paid up capital 140 and 500, reserves and surplus 70 and 5,500. So the total will be 210 and 6,000. Am I right? This is the shareholders fund, 210 and 6,000. Deposits of both the companies are 4,000 and 40,000. This deposit means the people, the normal public who has deposited their money in the saving account. So that's a liability of the bank. Deposits 4,000 and 40,000. Then other liabilities 890, 2,500. Total liabilities cash in hand with RBI, balance with other bank, investment, and this is advances. Have a look. Advances means the loans given to the borrowers, other assets and total assets. So this is 5,148 500. This is 5,148 500. Now it was decided to issue shares at a book value. Just a second. It was decided to issue shares at a book value of bank P to the shareholders of bank R. All the assets and liabilities are to be taken over at book value. For the swap ratio, weights assigned to the different parameters are as follows. Gross NPA is a negative factor. Remember this. The formula will be acquirer by target. Lower the better. And all the other factors are a positive factors, right? Positive factor. It will be target by acquirer, target by acquirer, target by acquirer. So this is very, very important for you to understand in this question. A lot of students who faced this question for the first time took target by acquirer in gross NPA cases as well. See, the target's NPA is 40% and the acquirer's NPA is 5%. And if you will take the target by acquirer as a ratio, it will come to 8:1. That means for one share of their company, you are issuing your 8 shares. That means so much of the ownership that you are giving to the other shareholders, irrespective of the fact that the NPA of that company is very high. So that 40/5 ratio will be totally wrong. This ratio will be totally wrong. It should be acquirer by target if the factor is negative, or we can say it should be lower the better. Okay. So what will be the gross NPA? Acha, there are four things that we have to calculate. The first thing is what is the swap ratio based on the above weights. How many shares are to be issued? It will be like the existing shares of the target company multiplied by the swap ratio. Prepare a balance sheet after merger. Okay. Calculate the CAR and gross NPA after merger. Very simple. So first of all, let's find out the swap ratio. What is the gross NPA? Acquirers NPA is 5%, targets NPA is 40%. So 5 by 40 comes to 0.125:1. What is the capital adequacy ratio? Targets capital adequacy ratio is 4% and the acquirers capital adequacy ratio is 16%. That comes to 0.25:1. This is the positive factor. Higher the better, higher the better, higher the better. Market price. Market price is 8 and 128. So targets 8, acquirers 128. 0.0625:1. Now the book value. Understand, the book value is nothing but the shareholders fund divided by the number of share, and you don't have the number of share given in the question. How will you calculate the number of share? The very first thing is assume that the paid up capital, paid up price of every share or the par value of every share is rupees 10. Because without this assumption, you will not be able to solve this question. So this is assumed. So if par value is 10, can I say the total number of share in bank R is 14 and the total number of share in bank P is 50? 14 and 50. Okay. So shareholders fund divided by the number of share, 14 and 50. We will get the book value. 210 divided by 14 comes to 15. 6,000 divided by 50 comes to 120. So do you understand? Have you understood this logic of book value? We have to first assume that the par value of each share is 10. Then we are going to divide the share capital with the par value to come to the number of share. 14 lakhs and 50 lakhs. That's the number of share. Okay. This is the book value, 15 and 120. So 15 is the book value of target, 120 is the book value of acquirer, and the ratio will be 0.125:1. What you have to do is you have to now multiply these ratios with the exchange ratio, these weightage with the exchange ratio. We have seen such type of questions in the past as well. Let's do the calculation. 0.125 into 0.30 m plus 0.25 into 0.20 m plus 0.0625 into 0.40 m plus 0.125 into 0.10 m plus. That's MRC, and the answer is 0.125:1. That means into, we can say, divided by 1. 1 share for every 8 shares. Let me just calculate it once again. See, 0.125:1, or we can say 1:8 share. For every 8 share of the target company, you are going to issue only 1 share of your company. So how many shares do they have right now? They have 14 lakh shares, and to them you are going to give 0.125 only, which comes to 1.75 lakhs. Right now you have around how many shares? 50 lakh shares. See, existing number of share is 50 lakhs. So after merger you will have 51.75 lakh shares in the share capital. But while merging the company, see, you have calculated the swap ratio, which comes to 0.125. You have calculated the number of share to be issued, which comes to 1.75 lakh shares. Now, before preparing the balance sheet, you need to ensure that how you are taking over the values. It is clearly written that all the assets and liabilities are to be taken over at book value. So what will happen? I will just show you. In the after merger company, the deposits will look like 44,000. Am I right? This will change. The paid up share capital and reserves and surplus of 6,000 will change. But the deposit, 210, right? This is the total of this is 210. So the deposit will be total, that's 44,000 in the balance sheet after merger. Other liabilities will also get total, that 2,500 by plus 890, that's 3,390. Total liabilities will be 48,500 plus 5,100. It will be like 53. Acha, this you can just avoid because this is just the total. Then cash in hand will be 2,900. Balance with other bank will be 2,000. Investment will be 16,100. Advances will be 30,500. Other assets will be 2,100. That's it. So this is how you are going to add the things, and when you will total all these things, it will come to 210, because this is what the credit balance is. Let me just show you the total of the asset side of this is just a balance sheet, but let's see what entry we are going to pass for merger. This will happen. See, let's focus on the assets first. We are going to debit all the assets of their company in our company. Let's start with the cash in hand with RBI. So cash in hand will be debited by 400. Investments will be debited by 1,100. Advances will be debited by 3,500. Other assets will be debited by 100. Okay. At the same time, we will credit the liabilities. So other liability will be credited by 890, and the deposits will be credited by 4,000. Do you get that? Deposits of the bank are is 4,000. So if you will now total the asset side and the liability side, this will come to 5,100, and this will come to 4,890. The balance is still 210 lakhs, which is exactly the total of the paid up share capital and reserves and surplus, which comes to 210 lakhs. See, 140 plus 70. Now, how this 210 lakhs will be entered in the books? Very simple, sir. We are going to issue them share capital, right? Shares. So share capital will be credited in our books. We have issued them 1.75 lakh shares of rupees 10 each, which comes to 17.5 lakh, and the balance will go to capital reserve. Whenever you merge or acquire a company, you are acquiring a fixed asset, or you are acquiring the entire company. It's the capital part. It's not the normal reserves and surplus, or it's not the operating reserves. It's the profit of acquiring a big company or a capital. So capital reserve will be 210 lakh minus 17.5 lakh, the balancing figure. That will be 192.50. So in this manner, all the assets and liabilities of bank R will get entered into bank P. So try to understand, bank P's balance sheet is as it is. Keep the bank P's balance sheet as it is and add the cash, investment, advances, these figures in the respective heads. Add share capital by 17.50. Your share capital will get increased, and there will be a new factor called as capital reserve in the balance sheet. See, Now we are going to prepare the balance sheet. Have a look. We had 500 earlier in the balance sheet. Now it's 517.50. Reserves and surplus will stay as it is because there is no change in it. There is one more head called as capital reserve of 192.50. So 17.50 out of this and 192.50 out of this will make 210 lakhs. Deposits will increase by 4,000. Other liabilities will also increase, and all the other factors on the asset side will also increase. The balance sheet has to tally. See, calculation of the capital reserve. The total book value of R Limited is 210 lakhs, out of which 17.5 lakh will go directly to the share capital of rupees 10 each. Rest will go to the capital reserve. So this is the balance sheet after merger. Okay, now the next part. Calculate the CAR, gross NPA, or percentage of bank P after merger. Very simple, sir. What is the formula for capital adequacy ratio? We will take it directly from the answer now. Capital adequacy ratio is the total capital that you have for the risky weighted assets. So all those assets, there is a particular formula or the guideline by the RBI where you can define different weights to the assets, and by multiplying those assets you will get the risky assets. So we can calculate it. Have a look. Right now let's start with the bank R. The bank R has the capital adequacy ratio of 4% and the total capital of 210 lakhs. Remember the total of share capital and reserves and surplus. So if you will take the capital adequacy ratio as 4% and that 210 lakh is the 4%, that means risky weighted assets, 210 divided by 4%, the total risky weighted asset is 5,250. Let me just explain you this. It means that the risky weighted assets that we have is 5250 on the asset side, and the capital for that we have is 210 lakh. So 210 divided by 5250, that's what the capital adequacy ratio was. Capital divided by risky weighted assets. So we had 210 lakhs of capital for the risky assets of 5250, which came to 4%. Do you understand the logic now? Now, if this figure is given 4% and this figure is given, can we calculate the risky weighted asset? Yes, sir. That's 5250. So what we did is we took the bank R, we calculated the risky weighted assets, total capital, and the total capital of P is 6,000 lakhs. Do you agree with this? 5,500 plus 500, share capital and reserves and surplus. This is nothing but share capital plus reserves and surplus before merger. So we had total capital of 6,000 lakhs and the ratio was 16%. So 6,000 divided by 16% will give you the risky weighted assets in bank P. This will not match with the balance sheet. Don't try to match it. So these two are the risky weighted assets in the pre-merger company. The total of these two will become the merged risky weighted assets. Merged risky weighted assets, and the total capital that we have is 6210 lakhs. It's the total of all this. We have the capital of 6210 lakhs as against the risky weights of 42,750 lakhs on the asset side. Can we calculate the CAR ratio now? Yes, 6210 divided by 42,750. The new ratio is 14.53%. I will just explain that to you once again. Understanding the fact that CAR is equal to the capital that you have kept aside for the risky weighted assets. We calculated this CAR as 4% for 210 capital of risky weighted assets. So we got the risky weighted assets to be 5250. We did the same thing for bank P. 16% was the CAR at 6,000 capital. So we got the risky weighted assets to be 37,500. Then we totaled this. The total of this was 42,750. So this will be the risky weighted assets under This will be the risky weighted assets under the merged company. And what is the total capital of the merged company? 6210. So what we did? Now merged entity CAR is equal to 6210 divided by 42750. That's it. We calculated the individual figures and then merged it to calculate the new CAR. We can call it as a merged CAR. That comes to 14.53%. That's a good amount. Okay. So in the similar manner, we are going to calculate the gross NPA as well. See, gross NPA is equal to NPA divided by advances. So for bank R, NPA was 40% is equal to NPA divided by advances. How much is the advances of bank R? If you will look at the balance sheet, you will get the figure. Bank R had the advances of 3,500. 3,500. So can we calculate NPA? Yes, sir. NPA, the non-performing assets were 1400 in bank R. Let's do that in bank P. It was 5%. So NPA divided by the total advances, which comes to 27,000. This figure. So NPA will be 27,000 into 5%. That's 1350. So total NPA comes to 2750. Now the merged NPA is equal to NPA divided by advances. NPA is 2750 of the both the companies, and the merged advances will be 3,500 and 27,000. So that will come to 30,500. That's around 9.02%. Do you get that? We have to calculate these figure individually from before merger companies, and then we have to merge it to calculate the merged NPA. See, 40% of 3,500 comes to 1,400, 5% of 27,000 comes to 1,350. Then we totaled it, and the total this one also. We have the advances, we have the risky weighted assets. It should be NPA, non-performing assets. Non-performing assets. NPA divided by gross advances. So we can say NPA divided by gross deposit, or you can call it as advances. It's not a printing mistake, it's by the institute only. So we have 9.02 as the gross NPA. Couple of things that you have learned about in this question is the first, how to calculate the swap ratio using NPA, what is the capital reserve, and what is CAR, capital adequacy ratio, how to calculate that, and the gross net non-performing assets. The formula is very simple, sir. Capital adequacy ratio means how much is the capital separated for the risky assets. Higher the better percentage. That means if the risk is too high, the capital should also be too high. In case of non-performing assets, this is a negative factor, this is lower the better. So how much of the total advances or the loans that you have given has become non-performing or can be created, said as debts, bad debts. In a normal company, it is called as bad debts. In banking sector, it is called as non-performing assets. So this is what the answer of this question is. Okay, sir. Try to revise this concept in the next two questions as well. This is also related to during the audit of weak bank and strong bank. Weak bank and strong bank, you have been given with the gross NPA and capital adequacy ratio, market price, book value, and trading on the stock exchange is irregular for this, frequent for the strong bank. So almost this 40% and 5% is matching. 5% and 16% is also near to the previous question. We have the paid up share capital, and in this question they have given that the par value is 10 rupees. We can easily calculate we can easily calculate the number of share. The number of share in this will be 15 and the number of share in this will be 50 when it is divided by 10 rupees. Okay, so reserves and surplus, you can clearly see that it is 5,500 in the strong bank as it was equal to the previous question. And rest of the details are given to you here. This is the total. This is the total. We have to calculate the swap ratio, number of shares to be issued, balance sheet after merger, CAR and gross NPA. Exactly same as the previous question. Leaving it up to you. The next question is also question number 40, which says XML Bank. The NPA is 40%, CAR is 2%, shares is trading at 4 rupees. XML, NPA, CAR, market price. See, 40%, 2% and 4 rupees. And there is another bank called as ZML Bank. This is a good bank which has NPA of 5%, CAR of 16% and the share is trading at 64 rupees. Exactly like the previous questions. You can calculate the number of share. This is 7 crore. This is 25 crore. When you will divide by 10, you will get the number of share. Reserves and surplus, deposit, other liabilities. This is going to be total liabilities. This is going to be total liabilities. The weights are given to you exactly like the previous questions. We have to calculate the swap ratio, number of share and balance sheet after merger. Please make sure that you create a capital reserve for the balance amount in the balance sheet after merger. See. The total of it is 105 crore. You are going to issue 7 crore of the share and the balance will go to capital reserve. The balance sheet should match at the end. That's it. So we have discussed about CAR, gross NPA and all. Let's have a look on exactly where we are standing in the concept category. So we started with all these concepts and we completed the promoters holding, free float, market capitalization, bonus ratio and stock split. We have officially entered into the third phase, which is the most important phase of our chapter, which is the most difficult also, and you might have realized by this question itself. Capital adequacy ratio, non-performing assets. Now we are going to solve some questions on maximum and minimum exchange ratio. Maximum and minimum exchange ratio while selling the company or buying the company. Okay. I will just give you some idea about the maximum and minimum exchange ratio. See, maximum amount will be paid or decided by the buyer. The buyer is concerned about the maximum amount. Or let's start it like this. Buyer, or we can say acquirer. Seller, or we can say target. See, which price a party will be worried about, maximum or minimum? Buyer always wants to pay as less as possible, right? He wants to buy a company at the lowest of the possible price. So he is not worried about the minimum price that at which he can buy. If we give him the minimum option, he will say that give me the company for free, because the minimum that I would like to pay is 0 rupees. I would not like to pay anything. So he is not worried about the minimum amount that he should pay to acquire the company. Whenever it is the question of acquiring the company, the buyer will be worried about the maximum price that he should pay. See, I will show you. If you want to buy this mobile phone, you are not worried about the minimum price of this. You are worried about the maximum that you should pay for this. If I ask you to buy it at the minimum price of 10 rupees, you will be easily buying this phone without thinking about it. But if I ask you to buy it at 1 lakh rupees, you will think twice before buying it, because as a buyer, the maximum side is the loss side to you, that can go to loss. So that is what you are worried about, the maximum amount that you should pay to buy a company. And as a vendor or as a seller, he will be deciding the minimum amount that he should be asking for to sell the company. The maximum, he is not worried about the maximum. If I am the seller and I have to sell the phone, I am ready to sell it at 10 crore rupees, 20 crore rupees, 1000 crore rupees as well. I'm not worried about the maximum price. No one is worried about the maximum price if he is the seller. They are obviously going to get worried about the minimum. So this is what is required to both the people. Whenever the question says the maximum amount, calculate it from the acquirer point of view. Whenever the question says minimum amount, calculate it from the point of view of the seller. That's what the logic and the meaning of this explanation is. The question will not ask you calculate the maximum amount for the buyer. No, they will just say calculate the maximum price of this share. You need to understand the fact that the maximum is only applicable for buyer, not for the seller. Seller is ready to sell it at any price, higher price. And to the seller, the minimum price will be very important to calculate. So buyer will be calculating the maximum price, seller will be calculating the minimum price. Now, next thing, let's say there is a company A and B, or we can say A and T. A for acquirer, T for target. The company's value is 1000 crore and this company's value is 500 crore. Okay. A knows that after buying that company, let's say for 500, we will get a synergy benefit of 200. Okay. So the total company, this is before merger, and this is after merger. So after merger, our company's value will go to 1700 lakhs. Now I have two questions to you. What is the maximum and the minimum price or value? It will be calculated for acquirer. For acquirer is where acquirer, or we can say maximum value of acquisition of target is equal to value at which acquirer is at no profit, no loss. That means pre-merger market value of acquirer should be equal to at least post-merger market value of acquirer. So try to understand. Before merger, we have a value of 1000 lakhs. And after merger, the total value of the company is 1700, and we want to keep 1000. We also want 1000 at least after merger, but the total market value of the company after merger is 1700. So how much maximum that we can give them is 700 lakhs. So the maximum value that we can give to the shareholders of the target company is 700 lakhs, because after merger market value will be 1700, and out of that we want our pre-merger market value to remain same. That means our value, acquirers, shareholders, market value after merger should be equal to 1000. So out of 1700, we will keep our 1000 aside and we will be ready to give 700 lakhs of shares to the target company for acquiring that. So the maximum value that acquirer will be ready to pay is 700 lakhs. But the minimum amount that the target company will be ready to receive is 500 lakhs itself. That is the pre-merger market value. If we give them 500 lakhs of shares, they are okay with it, because they are like, we had a market value of 500 before merger. We are also getting a market value of 500 after merger. So the minimum for the target will be 500. Maximum for the acquirer will be 700. And you can clearly see that acquirer will be ready to pay all the gains. Max to max, he will be ready to pay all the synergy gain that he or the acquiring company is getting because of acquisition. So we are getting an synergy gains of 200. So we can pay that much of the extra amount only over and above the current market value of the target company. That's it. Both the companies, if you will say maximum value or minimum value, both the companies would want their pre-merger market value to remain same after merger also. And the balance amount can be called as the, for acquirer, the balance amount will be called as the maximum that he will be ready to pay. Maximum that acquirer will be ready to pay is 700 lakhs, and the minimum that the target company will be ready to receive is 500 lakhs. Somewhere in between these two figures, the negotiation will happen and it will end. It's like this. It's like this. So how to calculate the maximum value? Very simple, sir. How to calculate the maximum value? Calculate the after merger acquisition price, after merger market value of the company, before merger market value of the company. The balance will be the maximum amount. And what is the minimum amount for the target? It's the pre-merger market value. It's the pre-merger market value of the target. That's the minimum amount. So I will just write down a formula. Maximum post-merger market value of acquirer minus pre-merger market value of acquirer. That's 1700 minus 1000. That's 700 lakhs. This is the maximum an acquirer will be ready to pay. And minimum value for target is equal to pre-merger market value of target. Simple. That is what the minimum they want, that at least give us the value which we are holding at present. In both the cases, no one will be at a loss. Okay, sir. Let's start with question number 41 now. Okay, let's have a look. ABC Limited is intending to acquire XYZ Limited by way of a merger, and the following information is available in respect of both the companies. You can see we have total earnings of both the companies and the number of share. With the help of this, we can calculate the EPS. EPS is 3 and in this case it is 2, right? Total earnings divided by number of shares. Now this EPS can be multiplied with the P ratio to come to the market price. So 8 into 3, 24 rupees, 7 into 2 is 14 rupees. Okay, we can also calculate the market value, the current market value of the company, which is nothing but the market price multiplied by number of share. So the market price is 24, right? 24 multiplied by 400 comes to 9,600, and 14 multiplied by 200 comes to 2,800. So this is the individual market value of both the companies. Please try to understand that ABC Limited is the acquirer. He will be ready to pay all the amount which will result into the post-merger market value of ABC to remain at 9,600 at least. And XYZ will demand at least 2,800. So, okay, that's the first question. Now, first question is determine the maximum exchange ratio acceptable to the shareholders of ABC Limited, because that's what they are worried about, the maximum. If the P ratio of the combined firm is expected to be 8. Okay, Let's do the total of the earning. It is 1600 lakhs. Total earnings of both the companies 1600 lakhs. So this total earning when multiplied by the P ratio of 8 will give you the combined market value. That's 12,800. So before merger the market value of ABC is 9,600. After merger it's 12,800. ABC would want to keep its 9,600 market value in the after merger company as well. So if we will deduct 9,600 out of this, the balance amount can be distributed 3,200 to XYZ. That is the maximum that you will be ready to pay. But the question is not asking about the maximum value. The maximum value is 3,200 that you can pay to the shareholders of XYZ Limited. But they are asking you the maximum exchange ratio. Exchange ratio is only calculated when you can compare the new number of share that has been given to the old shares, that is 200. Right now XYZ Limited is holding 200 lakhs shares. How many shares that we are offering them in ABC Limited? That's what we have to calculate. And it's very simple, sir. See, I will show you. Combined earnings is 1600 lakhs. P ratio after merger has to be 8. So market value after merger should be 12,800. Right. This should be the market value after merger. Now this 12,800. Out of this 12,800, ABC, right? Which company is that? ABC is the acquirer. ABC would want to keep 9,600 lakhs their value as it is. Their number of share is 400 lakhs right now. And the balance amount can be distributed to, that is 3,200 to the XYZ. Now try to understand that every share is worth 24. 9,600 divided by 400. Every share of ABC Limited has to be worth 24. They have 400 lakh shares, and if the market price of the share has to be 24, the total value then will remain at 9,600. That's what they want. So if the share price has to be 24 in this case, it has to be 24 in all the cases as well. So with the help of this 3,200 divided by 24, we can calculate the number of share to be distributed to XYZ. Very simple. Number of shares for XYZ is 3,200 divided by 24 comes to 133.33 lakhs. So exchange ratio. The maximum exchange ratio acceptable is we can give maximum of 133.33 lakh shares to the 200 lakh shares that they are holding right now in their company. See, they are holding around 200 lakh shares. We can give them only 133.33 lakh shares in the new company, and the exchange ratio comes to 0.667, or we can say 2:3, or 0.667:1. Let me just go through the answer. See, 133. This is a different formula, but this entire thing comes to 24 only, which is already there. We have to keep our market price constant after merger as well, because we want our value 9,600 to be as it is after merger. All in all, if we don't want to lose anything, the market price of our share should not go below. So at least it should be 24. After merger market value should be 24. That's it. So 3,200 that we can distribute divided by 24 will be the number of share that we can distribute to them. Okay. If we want to determine the minimum exchange ratio acceptable to the shareholders of XYZ Limited, if the PE ratio of the combined firm has to be 10. If the PE ratio of the combined firm has to be 10, then what will happen? The total earning is 1,600. 1,600 multiplied by 10, the total market value will be 16,000. That's okay. How much amount the XYZ Limited would want in 16,000 of the market value? They would want at least 2,800 lakhs of value. How to calculate that? That's 2,800 is the pre-merger market value of XYZ that they would want to continue minimum that they want to continue that much amount in the after merger company as well. So have a look. I will just show you. Combined earning, it's very simple, sir, is 1600 lakh, P ratio has to be 10, the combined market value will be 16,000. Try to understand. XYZ, this is XYZ and ABC. Now, if we want to calculate the minimum, we will keep XYZ's market value in the post-merger company as 2,800, which was their pre-merger also. And the balance amount can be kept by ABC Limited shareholder, and those shareholder are 400 in number. Try to understand. Those shareholders are 400 in numbers. We are not giving any new share to the existing shareholders, right? So the market price after the merger has to be 33 for each share. And if it has to be 33 for each share, how many new shares should be distributed to XYZ? It should be 2,800 divided by 33. That's 84.84, or we can say 84.85 lakh shares. This much of the shares has to be issued to XYZ only to make sure that their market value is 2,800 after the merger also. This is the minimum that they want. 84.85 lakhs. So what will happen? What is the exchange ratio? Exchange ratio is we want 84.85 lakh shares as against 200 that we are holding right now. So the exchange ratio comes to 0.4242 is to 1. 0.4242 is to 1. Understand once again. We want the minimum amount, right? Second part. 1600 is the total earning multiplied by 10, 16,000 is the total market value. And XYZ wants to keep minimum of 2,800 out of it. That means the rest of the amount can be distributed to ABC Limited shareholder, 13,200. And the number of shareholders of ABC right now is 400, which comes to the market price of 33. That means every share in 16,000 crore of the market value has to be worth 33. So if you will divide 16,000 by 33, you will get the total number of share. That comes to 484.85, out of which 400 shares are kept by the acquirer itself. So the balance share can be distributed to XYZ and the ratio will be 0.4242. See. We can give them 84.8485 shares. So the market value after merger of the target company should be 2,800 lakhs. So if you look from the acquirer point of view or the target point of view, I will just summarize all these things. If we look from the acquirer and the target point of view, acquirer will give maximum of 12,800, or I will just write down the value. Target company's value, it is ready to give 3,200 and it is ready to receive at least 2,800. But you will calculate the market price first. If you will divide the market price, you will get the number of share that you will issue to the target companies, and it will be divided by 200 to arrive at the exchange ratio. So in that case, the exchange ratio was 0.667 is to 1, and in this 0.4242 is to 1. Now the entire story is about the market price. Market price can be calculated very easily. In case of acquirer and target, it was 9,600 that we had to maintain. Acquirer wanted minimum of 9,600 to be the market value of their own share after the merger, and in case of Target Limited's minimum plan, the acquirer was getting 13,200. 13,200 and their number of share were 400. So we got the market price. In this case it was 24 as it is. In this case it is 33. That we kept in the previous part. That's it. We will solve more questions on this to understand how we can calculate it. If I want to summarize from this question, we can formulate maximum shares that can be offered is equal to post-merger market value of acquirer minus pre-merger market value of acquirer. This is the amount that we can give them divided by. Simple. Post-merger market value of acquirer minus pre-merger market value of acquirer is the extra gain or the increase in the market value of the company because of the acquisition that we can distribute to the target company. In that case, we will ensure that our market value, acquirer's market value, is not diminished. Okay. Then divided by the market price of acquirer. Existing market price of acquirer will do the work, that is 24 rupees, because if that will be kept constant, that has to be kept constant, we have to keep it 24 itself after the merger. That's it. So this can be the formula to calculate maximum shares that can be offered to target. Okay. And minimum shares acceptable to target company can be calculated as pre-merger market value of target divided by post-merger market price of acquirer. So we would want that the value that we are holding before merger should continue after the merger also. So this much of the value we will ask or request at a post-merger market price of acquirer. That will ensure that we are getting the shares. We are getting this much of the shares at this value in order to maintain the pre-merger market value. So post-merger market value of acquirer has to be calculated at that time. In this case, it can be said that we can take current market price of the acquirer, but in this case we have to calculate the post merger market price of acquirer. Okay sir, let's have a look on the new question now. The equity shares of XYZ Limited are currently being traded at 24 rupees. XYZ Limited 24 in the market. XYZ has a total of 10 lakh equity share outstanding in number, and the promoters equity holding in the company is 40%. That means 4 lakh shares. Do you agree? So this is a company with a market price of 24 with the number of share of 10 lakhs and the promoters are holding 4 lakh shares. PQR Limited wishes to acquire XYZ Limited. So there is one company who wants to acquire XYZ Limited, that is PQR, because of the likely synergies. The estimated present value of these synergies, extra benefit due to merger. That's 1 plus 1 is equal to 3. That extra 1 is called as the synergy. Because there are some synergy benefits on acquiring XYZ company, we as a PQR Limited wants to acquire this. The benefit of this will be 80 lakh rupees. That means after acquiring that company, we can have a greater market value. So right now the market value of this company is 240 lakhs, right? 10 lakh number of shares at 24 rupees. Right now the market value of the company is 240 lakhs. Plus after acquiring this company, the present value of the synergy is 80 lakh. We can increase the market value by 80 lakh. So the total market value of PQR will increase by 320 lakhs. That's the benefit. Okay. Further, PQR feels that the management of the XYZ Limited has been overpaid. With better motivation, lower salaries and fewer perks, the management has been paid over, right? Now we are going to motivate them, lower their salaries and fewer perks for the top management will lead to the saving of 4 lakh per annum. Right. Top management with their families are promoters of XYZ Limited itself. So what is happening? We as an acquirer are feeling that the promoters of this company is being paid extra. So we want to lower their salaries. Okay. Present value of these savings, these 4 lakhs. Present value of the 4 lakh rupees per annum has been calculated as 30 lakhs in the value of the acquisition. So that will also increase in the market value. In total, 350 will be the increase in the market value of our company. 240 lakhs of the company that we are buying, 80 lakhs of the synergies and 330 lakhs because of the reduction in the salary. Following additional information is available regarding PQR Limited. Earning per share is 4. Total number of equity share is 15 lakh and the market price per equity share is 40. This is the acquirer's detail. What is the maximum price per equity share which PQR Limited can offer to pay for XYZ Limited? Maximum will be always paid by PQR. That is acquirer. Now try to understand. This is PQR. This is XYZ. The current market value of both the companies. This is 240 and see 15 lakh multiplied by 40 market price. So that's 600. So this is the current market value of both the companies before merger. But after merger, what will happen? The market value of PQR will increase by 240 because you are buying that company, plus 80 lakhs because of the synergy benefit, plus 30 lakhs because of the lower salaries. So after merger market value will be 950, right? So from PQR's angle, PQR can pay maximum of 350 lakhs. PQR would want to ensure that 600 of the market value that they had before merger should continue after the merger. So out of 950, they want a market value of 600 and the maximum that they can distribute is 350 lakhs. So this is the maximum. And this is the maximum that we can pay. Question is, what is the maximum price per equity share that we can offer to pay? So we can pay them 350 lakh rupees to buy that company, not just 240. You might say that 240 lakh should be paid because their company's value is only 240. No, sir. 240 is the company's value that we are buying, but because it will get merged into our company, we will save up on these costs also. And the total benefit to us because of the acquisition is 350 lakhs that we can distribute totally. So whatever the benefit of acquisition, if we distribute to them XYZ, then we will be at a no profit, no loss situation. So that becomes the maximum amount payable. Their number of share is 10 lakhs. So we can pay them 35 rupees for each share. That's the maximum that we can offer them. How many number of shares are there? For XYZ, it is 10 lakh shares. And if we have to pay 350, we can pay maximum of 35 rupees per share. That's the maximum benefit, right? So have a look. 240 plus 80 plus 30. That's what we are getting by acquisition of this company. So 350 lakh. 350 lakh divided by 10 lakh, 35 rupees we can pay in total. That's it. This is alternatively swap ratio is calculated. This is a lengthy process. You can just follow this one. Okay. What's the next question? From the acquirer's point of view, see, from the target company's point of view now, what is the minimum amount that XYZ would want? XYZ would want 240 lakh rupees. That's it. So pay them 240 divided by 10. That's it. 24 rupees. But This would have been applicable only if there would not have been any additional information. Now have a look on the second part of the question. What is the minimum price per equity share at which management of XYZ Limited will be willing to offer their controlling interest? See, look out on this question from the angle of the management. The management is holding 40% in the company right now, 4 lakh. Each share is worth 24 rupees. So this is the minimum that they would want for giving up their right. But after giving up the right, after their company gets merged into XYZ, their salary will get reduced. Do you know that? Question clearly says that we are going to reduce the salary of the XYZ. And that includes the top management, that is the promoters. Promoters' salary for working in the company will get reduced, and the present value of that is 30 lakh. So try to understand now. From the management point of view, they are losing 4 lakh shares into 24. That's 96 lakh rupees. Also, they are losing in terms of the salary, that is 30 lakh rupees. After merger, they will not hold this much of the share and they will get lesser salary for this much. So, loss due to merger is 96 plus 30. That's 126 lakh. Loss due to merger, and because of that, they would want to recover this much of the loss at 4 lakh. So when you will divide it by 4, it comes to 31.50. Management would demand at least minimum 31.50. It's very simple. 24 rupees for giving up the control, that is shares, and 6 rupees 50 paisa for lower salary that they will be offered in the after merger company. Right now, let's say for example, I am the promoter of this company. I am working in this company. I am taking two benefits from the company. I am holding the shares worth 24. I am also getting the salary because I am working for this company. So after merger, what will happen? I will lose the shares that I have right now. So I will ask for 24 rupees, pay us. Plus I will get a lesser salary in that company. As compared to this company, I will get a lesser salary in that company. So I will ask that loss also. That is 30 lakh rupees. They are going to pay me 30 lakh rupees in terms of present value, lesser amount by 30 lakhs, right? So see, 96 and 30 lakhs is what I am going to lose. Calculation of the minimum price per share at which the management of XYZ Limiteds will be willing to offer. So value of the share and present value of the loss of remuneration to the top management. This minimum price was not calculated from the entire target company's angle. It is only from the management's angle, which are holding 4 lakh shares. So management is losing 24 rupees on each share plus this lesser remuneration, loss of remuneration. But if you talk about a normal public who is not the management, that is rest of the 6 lakhs, they will only ask for 24 rupees of the minimum share price because they are not getting salary anyways. So after merger, it won't affect them. Right now their market price, their shares market price is 24, and that is the minimum that they would demand for giving up. But management would demand extra loss of remuneration. Okay, come over to question number 43.